back. You're still tuned into Trading Hour. Let's talk about market fundamentals now. Dharmesh Kant, the head research at Chola Securities, is joining us now. Dharmesh, good morning. Thank you so much for joining in. Well, we are just entering that earnings season. So for FY26 itself, what kind of EPS growth are you looking at? And which are some of the sectors which would contribute to the growth that we'll see this year?
Yeah, good morning and thank you for having me. I think Q1 should be again be a muted quarter for the earnings growth trajectory. It should be in a single digit kind of a zone. But for entire FY26, we are seeing around 9 to 10% kind of a growth on a base case basis. And on the upside, it can go up to 12 to 13%. And the sectors which are likely to perform better is from the mainstream banking and financials are likely to do well. Though, I mean, a lot of catch points are there as to the NIMS compression or, but to our mind, from Q2 onwards, the tailwinds will start playing out. And that is where the heavy lifting will be done. Apart from that, Reliance Industries, some support from the IT companies and the automobile sector is looking pretty fine to us. So these are the headline, sectors into the Nifty 50 basket, which are likely to drive the earnings growth going forward. So Q1 should be mark the end year after 3 good years of good performance. And this is a time to do your cherry picking.
Dharmesh, good morning. Thank you for joining in. You highlighted the list of sectors and including Reliance Industries that could lend some support to the earnings growth. But which are some of the sectors that you're cautious on going into the earnings season?
Yeah, good morning, Dharmesh. The sectors which we don't like at all is one is the FMCG basket. Though a lot of buzz has been made because of the tailwinds of low inflation, lower interest rate, and the good monsoons. Things are likely to pick up there. But look at the entire space. The entire space is available at a PE multiple of more than 50x and with ROEs of around 15 to 25% and a single digit kind of a growth. So I don't think the next decade is going to belong to them. It would be more to a growth sectors like defense, railway infra, construction, building materials, and the likes with renewable energy segment. So FMCG one basket which we are avoiding, and then the other basket which we are avoiding this entire FY26 is the pharmaceutical space. There also, to our mind, 15-17% can be the best case scenario for the profitability growth. And the valuations are already stretched for most of those companies. So there also stock price action won't be there.
On FMCG, you said you don't like it, but so far the updates are pretty okay, pointing to some healthy recovery, particularly in the rural market. Urban is also showing nascent signs of a pickup. So is it the valuation that makes you uncomfortable? What is it? And what can change your mind on FMCG?
Yeah, definitely. Yes, Rima, if you look at updates, it has been a low single digit volume growth. And with blended realization, the best scenario can be made is around 8 to 9% kind of a value terms kind of a top line growth with some stable margins. So if you are compounding at say 10-12% kind of an profitability, valuation definitely becomes a concern if it is available as a 50-55 times 1 year forward PE multiple. So that is the challenge for the entire FMCG basket. Last decade was different. It was a time when you were looking at stable earnings growth, but going forward, the next decade would be more on the growth drivers where you can find at least 15-20% kind of earnings growth because the index itself is available at 20-21 times PE multiple, and this is likely to continue for at least 2-3 years going forward. So to our mind, it's a growth sectors with sustainable, stable kind of earnings trajectory. Visibility should be there. Those are the sectors which would be driving the growth on the stock price as well, rather than FMCG. It can be at best a trading place. In between, you can get with such, 7-8% kind of blended realization update coming from Dow or others in the like. You can get a trading pop of 5-7%, but that should be the end of it.
Okay. Dharmesh, you have some cyclical plays as well that you're looking at this juncture where we are in terms of a macro cycle. Some of that which would immediately work out and some which would take some time to see some reward?
Yeah, the things which can immediately work out is the automobile sector. And there, I think Hero MotoCorp remains our topic. The reasons are very obvious. One is the valuation comfort is there. It's available at 18x 1 year forward PE multiple. And it is just, the volume sales has just picked up on the entry level side with all the tailwinds of lower EMIs and better monsoon, with festive season coming in, with marriage season already playing on. So I think 550,000 run rate of its motorcycle sales for next 2 months is likely to be in place. And then the base effect also comes into play because Last year, if you look at July, they sold around 3,70,000 bikes, and August it was 5,12,000. So there also optical, a run rate of 10-12% kind of a growth would be there. It's already down 30% from its peak level. I think this company can easily command a P multiple of 2021. So this is one play which we are liking from the automobile space. Other than like the likes of say M&M or Eicher Motors, so those two are the two different picks which we are liking. And the others as a segment, the theme which we are liking is the entire renewable energy segment, be it IPP like independent power producers like NTPC Green, or solar panel producers like Waaree Energy, or the power financiers like PFC. Again, everywhere there's a huge valuation comfort as well as the compounding of 20-25% kind of earnings trajectory is there. So these are the baskets which we think if you're holding it for 3 to 4 months, decent upside of 10-15% on stock price can be expected.
What about the PSUs? I was about to ask you that question, Dharmesh. Their entire wide gamut that the PSUs have, the stocks have run up significantly, right? Be it the defense names, the railway names. Where is it within the PSU basket other than the RECs and the PFCs where you find comfort, or you do not find comfort in any other space within the PSUs other than these names?
See, I mean, two comfortable spaces. One is defense, but that again is from a long haul. You should not be looking at from 1 year, 2 year kind of a perspective. If you are looking at the defense space from 3 to 5 years perspective, it's a very good bet. I mean, the reason being, if you look at the entire, sales of top, say, 13, 14 companies in the defense space, it is around 70,000 odd crores. You can buy 30 Rafales or 15 nuclear submarine at that kind of a revenue. So I mean, plenty of scope there from overall and servicing company to a ship to sub-part and part manufacturing to eventually a OEM kind of a manufacturer. So that is one space which we are lacking from a good investment perspective, but you have to be patient and keep it holding for at least 3 to 5 years. And the other space from the PSU gamut which we are liking is the railway infra space. Again, a lot of modernization and things are likely to take place in the railway space. It's not just metros and, 4-laning or multiple railway line tracks being there. It would be eventually a bullet train kind of system as is evident in Europe and other countries. So India will eventually migrate to that. That will again entail a lot of capex, a lot of, revenues and profitability building into these companies. So there, I think Ircon International looks decent compared to the valuation multiples with relative peers like RVN and all. So these are two spaces which to our mind looks very attractive, but these are, long distance space. You should not be looking at it from a quarterly basis, rather look at it from 3 to 5 years kind of perspective.
Thank you, Dharmesh, for joining in and sharing your perspective.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.